Today, we are diving deep into a strategy that really separates the pros from everyone else. It's called multi-timeframe analysis, and we're going to answer the big question: how can you effectively combine 3 different timeframes to get a real, tangible edge in your trading? Let's jump right in. Oh man, we've all been there, right? You see a setup that looks absolutely flawless. You jump in, feeling confident, and then bam, the market just rips against you out of nowhere. It is so frustrating. You start to think, is this whole thing rigged? But what if the problem isn't the setup? What if it's just your perspective? Okay, look at this, because this reveals the classic trap. On the left, that 15-minute chart, it looks like a textbook buy. You've got a nice little uptrend, a pullback to support. I mean, what's not to love? Well, take a look at the right. The 4-hour chart tells the real story. You're not buying a dip at all, you're buying right into a massive brick wall of resistance. It's a trap, and you never see it coming if you are only looking at that one small chart. So, how do we avoid falling for that? Well, we're going to build a complete system, right here, right now. First, we'll talk about why trading on one chart is like flying blind. Then we'll cover the top-down principle that pros use. After that, we'll build out a simple 3-timeframe system and a 3-step process to use it. And finally, we'll look at the proof and the pitfalls you got to avoid. Relying on just one time frame, it's like trying to drive across the country using only a super detailed map of one small town. Yeah, you can see every single street and stop sign right in front of your face, but you have absolutely no idea if you're even on the right highway. Or worse, if you're driving in the completely wrong direction. And that leads to probably the single biggest and most expensive mistake that traders make. It's called the bottom-up approach. They'll find some little signal on a 5-minute chart and then scroll out to the bigger charts trying to make it fit. That just clouds your judgment and honestly almost guarantees you'll end up trying to swim against the market's main powerful current. And trust me, that is a game you just don't win very often. The solution? It's simple. We flip that whole process on its head. Professionals use what's called top-down analysis. It's all about starting with the big satellite view first, seeing the whole map, so to speak. You figure out which way the traffic is flowing, and only then do you zoom in to find your specific on-ramp. And this top-down approach, it's got a name: Multi-Timeframe analysis, or MTFA for short. All it really means is looking at the same stock or currency pair through different lenses, different timeframes, so you can build a complete, holistic picture of where the market really wants to go. Now, you might be thinking, okay, great, so how many timeframes do I need? 5, 10, 20? Well, that's a fast track to something called analysis paralysis, where you're just drowning in information. The key is to keep it simple but powerful. The professional standard is the rule of 3. We use 3 and only 3 timeframes to create our entire analytical toolkit. And this table here breaks it down beautifully. Each frame has one and only one job. Your high time frame, that's the anchor. Its only job is to tell you the main trend. Are we in a buyer's market or a seller's market? That's it. Then the mid time frame gives us the context. This is where we look for our setup, like a nice pullback to a key area. And finally, the low time frame is the trigger. This is for execution only. It helps us pinpoint that exact moment to get in with minimal risk. So, which 3 timeframes should you use? Well, that totally depends on your personal trading style. This gives you a really clear, practical guide. If you're a swing trader holding for days or weeks, your anchor is the weekly chart. If you're a day trader, it's the daily. If you're a scalper, maybe the 1 hour. The general rule of thumb is to use a factor of about 4 to 6 between each one. So just pick the combo that fits you and your schedule and then stick to it. Alright, we've got the theory down, we've got our tools. Now let's make this thing real. Let's put it all together into a simple, repeatable, 3-step process you can use for every single trade. This is where the rubber meets the road. And look, the process perfectly mirrors our toolkit. It's this simple. Step 1, get your bearings on the high time frame. Step 2, wait for the right context to show up on the mid time frame. And step 3, find that precise trigger on the low time frame. So let's walk through a day trading example using the daily, the 1 hour, and the 15-minute charts. Okay, step 1, we go to our anchor chart, the daily. We're looking at the big picture. And here, we see a clear pattern of higher highs and higher lows. The main trend is clearly up. So we mark out the most important, most obvious area of support. And that's it. Our analysis on this chart is done. Our bias is now locked in. We are only looking for buying opportunities, period. All sell signals get ignored. Now, we drop down to our context chart, the 1 hour, And here's the crucial part. Our job on this chart is not to trade, it's to wait. We can see the price is way up high, so we absolutely do not chase it. We sit on our hands and we patiently wait for the market to pull back to us, back into that major support zone we found on the daily. This step right here is all about discipline. Okay, and finally, once the price has arrived in our predefined zone, it's time for step 3. We zoom in with our trigger chart, the 15-minute. Now we go from waiting to hunting. We're looking for one specific little signal that tells us the buyers are stepping back in. Maybe it's a bullish engulfing candle, maybe it's a pin bar. Whatever your signal is, the moment we see it, and only when we see it, we pull the trigger and enter the trade with a nice tight stop loss. You see how this process works? It's a filter. It ensures we're only taking the highest probability trades that are flowing with the market's real direction. But does it actually work? I mean, really? And what are the dangers we need to look out for? Let's check out the data. You know, the numbers here are they're really compelling. When your trade isn't aligned with a bigger picture, your win rate is often less than a coin flip, maybe 39%. But when just 2 of your timeframes line up, that jumps to almost 60%. And when you get that perfect alignment, when the anchor, the context, and the trigger are all in sync, your probability of success can soar to over 70%. That, right there, is your statistical edge. But look, even with an amazing system, you can still get into trouble if you fall for these common traps. First, stick to 3 timeframes. Any more just creates confusion. Second, never ever ignore your high timeframe. It's called the anchor for a reason. Third, always wait for that confirmation signal on your low timeframe. Don't jump the gun. And finally, be patient. Let the market come to you. Don't go chasing after it. I love this quote because it just perfectly sums up the entire mindset. Your job as a trader is not to be clicking buttons all day. Your real job is to do your analysis, mark your zones, and then wait with incredible patience for everything to line up. The execution, that's the easy part. The real money is made in the waiting. So you see, this isn't just another technique. It's a disciplined process for finding clarity in what often feels like total chaos. You now have the map. The only question left is, will you have the patience to follow it?